Thank you, Venda. Bonjour à tous. Good morning, everyone. I'm Yannick Blais-Gauthier. I lead the EY Financial Services Risk Management team in Canada, and it is my honor to introduce our great panel of CROs today. First, David Latour is an Executive Vice President and Chief Risk Officer at La Caisse, with over 20 years of experience in risk management and investing across public and private markets. He held various credit, liquidity, and counterparty risk management positions after earlier positions at RBC. He has contributed to the GRI's research and is a champion of the Women in Risk program at GRI. Thank you, David. Shannon McGinnis is Executive Vice President and Deputy Risk Officer at Scotiabank, overseeing retail, commercial, and small business credit risk. She's also a former member of GRI's Sustainable Finance Advisory Committee, where she drew on our extensive background in risk management, banking, and governance. Thank you, Shannon. Kelly Hepher, is this the right name? Is Executive Vice President and Chief Risk Officer at IGM Financial, overseeing risk, corporate sustainability, and internal audit across the firm and its subsidiaries. And finally, Romy Bowers is Chief Risk Officer for the International Monetary Fund based in Washington, D.C. She brings over 20 years of experience in both public and private sectors in North America, having previously served as President and CEO of CMHC and in senior finance and risk management positions at Bank of Montreal. Thank you all for agreeing to share your insights with us today. On a more personal note, and I hope, David, you'll indulge me here, but it gives me great pleasure to introduce a panel with 3 female CROs. I'll now turn it over to our moderator, Sharak Shahabi Azad, who is the director of research at GRI. Thanks everyone.
Thank you, Yannick. Good morning, everyone, and welcome to the CRO panel discussion on risk as strategy, how chief risk officers drive value in uncertain times. As risks evolve and new ones emerge, risk management is also evolving to meet today's challenges, from navigating emerging risks, including geopolitical and regulatory pressures, to positioning risk as a catalyst for innovation and resilience. This discussion is to offer insights into how CROs are driving value in an increasingly complex environment. We're fortunate this morning to have a distinguished panel of experts with us, and with everything that is going on in the world, I think this will be a very informative session. As Anna indicated, please submit your questions through the CVent app. I will collect them on my iPad and work them into the conversation as we move along. So let's begin. This morning, our keynote speaker, Mr. Garry Kasparov, spoke about several emerging issues that pose risks to everything from global dynamics, security, international relations, and the emergence of technologies that could potentially even undermine institutions. So my first question to the panel is, and I know you would have anticipated this question, what is that one risk that is top of mind for you? What makes this risk particularly concerning, and how are you preparing for it? Shannon, I'd like to start with you, please.
Great, thanks, and good morning, everyone. So probably not a surprise, the top risk I'm going to maybe spend a moment on is geopolitical risk. Just recognizing, and I think you would have heard it in the session before us, we're operating in a very dynamic, challenging time that is evolving. Sometimes it feels like on a daily basis. And so when we think about all the risks we're managing, that's one that we are quite focused on. And in terms of how we manage it, a lot of it is going back to very fundamental risk management practices. So we are constantly monitoring what's happening in the environments that we operate and trying to understand the potential impact. We're looking at different scenarios. We're doing stress testing. We're talking to our clients. And through all of that, what we're really focused on is how do we prepare? How do we get prepared for whatever outcome might come our way? So that's one of the things that we focus on. I think others would share the same. As well, we obviously operate in a number of footprints, and so we leverage our local teams. Geopolitical risk is borderless, but the impacts can be different depending on where you're operating. And so having that local, on-the-ground perspective is really critical as we're navigating through it.
Thank you. Romy.
So maybe taking a little bit of a different tack from Shannon, one of the things that I would worry about is risks associated with housing in Canada. And in July of this year, the IMF published what we call the Financial Sector Assessment Program Report. And in that, we highlighted vulnerabilities in the housing sector. And again, this is not to say that things are in good shape in Canada in terms of the banks are well capitalized, institutions are strong, the regulatory system is working very well. However, there's no doubt that there is risk in the housing sector. We saw about a 60% ramp up in house prices during the pandemic. It's come down a little bit since then. But there is, I think Canada has the highest level of household indebtedness in the G7. We've seen, interest rates have been, going up, and there are strains on households. And, the Canadian banks get through the stress tests really well, but there still are vulnerabilities that require monitoring. In terms of what needs to be done, I think, the regulatory authorities in Canada need to keep on doing what they're doing now. I think the framework is strong, but any stresses always emerge in ways you never anticipate. So I think having that sort of creativity, proactivity, what's really great in Canada is the strength of institutions and the dialogue between industry and the regulatory bodies, and I think that needs to continue as well. But more fundamentally about housing, and I put on my former hat as the head of CMHC, is that housing affects so many things, like the day-to-day life of Canadians. And in particular, housing affordability affects those who are the most vulnerable in our society, low-income households, young people. And it's not just a sectoral issue, it's a systemic issue in Canada. And addressing the housing affordability issues takes a lot of strategic thinking in the long term. And I think ultimately that's what's going to reduce the risk in the system.
And I'm glad you mentioned that, because I do have another question that maybe we'll get into it a little bit more detail, especially when talking about extended period of labor market weakness and how this all ties into potential risks for the Canadian economy. Kelly, top of mind.
Thanks, Sharon. Yeah. So I was reflecting about this over the last few weeks and thinking, how on earth am I going to narrow this down to one thing? I'm paid to worry about everything, and I do. But maybe I'll narrow it down to two. For those of you that don't really know IGM Financial, we are essentially an asset manager and a wealth manager. Okay, so you'll have already noticed one of these things is not like the others. So we worry about slightly different things, and the obvious one is the market. The market's good and ready for a pullback, and I don't know what's going to cause it. It might be geopolitical risk. It might be that the AI story suddenly turns sour, and that's the only thing that's holding up the equity markets. We'll see. But I do really, really worry about that pullback. So that's point number one, but fairly self-evidently. The other one that I worry about, frankly, is the one that Gary touched on this morning, which is AI, and specifically how AI is turbocharging fraudsters. And this is going to be a tough go for a while, really tough to stay ahead. We are very much scrambling and making sure that we're not at the back of the pack, but that is something that keeps me awake at night, is the fraudsters grabbing hold of our organization. So those are the two. Forgive me for breaking the rules right out of the gate.
When you talk about fraudsters, are you talking individuals or more nation states?
Either or sort of gangs of people who are just really only interested in the money, etc. The things that you can do to fraudulently get into organizations these days with the assistance of AI are frightening, and staying ahead of that is going to be very important for all of us.
David, your thoughts? I know you're going last, but I know there's lots to cover here, so I don't think
sure.
risk
I'm
of
actually going in
overlap?
the same direction, Kelly. I think for me, AI is the big challenge that we're all going to have to face in the next decade or so. If you define risk as the uncertainty of outcome, well, AI is pretty much that very definition. What will the world look like in 10 years from now? Nobody has a clear view right now. It's going to challenge how certain sectors operate. It's going to make some disappear completely. But everybody's going to be impacted one way or the other. You don't have to believe me or Kelly for that. If you spend just a few days on the West Coast of the United States talking to those venture capitalists in terms of understanding what they're looking for and in what they invest in, if you just walk around San Francisco, surrounded by driverless cabs everywhere, it's not just one, it's literally at every corner, you'll see that all of this is not science fiction. This is coming. We don't know when exactly, but this will change how we operate. It will impact our portfolio companies, and we have to be really prepared to understand who are going to be the winners and the losers in order to deliver the long-term performance our depositors expect from us.
Thank you. So I did ask about what is top of mind for you in terms of concerns. I do have a question from the audience that the CRO role is complex and challenging. What aspect of the job do you find most fun? For a bit of a curveball. Shannon, if you'd like to take it, and then...
I actually think that is what makes it fun. I think what's great about these types of roles is that your accountability is to be on top and to understand, everything that's happening both within your organization and outside the organization. And so I personally find that quite stimulating and quite fun. But
I completely agree. And you get to stick your fingers into everything. Right, like it's actually a really broad perspective across the organization. Sometimes it's a bit sort of depressing, and you can kill a dinner party good and quickly. You walk in with the hood and the scythe, but it is a very, very broad perspective across the organization, and you do get to see an awful lot. It's really good.
So on that note, and based on the responses that you provided, the role of the CRO seems to have really evolved. It's not just about looking at maybe historical data and then drawing some kind of inference for a future event. You need to be aware of geopolitical events, technology, climate impacts, global security, and of course the macroeconomic trends and the statistic modeling. David, you wrote a commentary piece for GRI titled The Evolution of the Risk Management Profession. How has your role as CRO evolved beyond the traditional risk management into strategic partnering? In particular, what new capabilities are you building into your risk teams? And how do you measure if those new functionalities are the right ones for the organization?
Sure. So it's not only the CRO, like you said, it's the whole risk management industry that's being challenged, that needs to evolve. When I started 20 years ago, we were just basically a bunch of quants, right? Running numbers. And if you look at the family portrait of the team now versus what it looked like many years ago, it's just a completely different skill set. Obviously, we still need to have very strong quant analysis, and that's always going to be part of what we do. But all of a sudden, we have to be able to opine on climate risk. We have to be able to opine on geopolitical events. We have to have a view on where AI is going to take us. So we need to be able to recruit people that actually have that diverse background, that help us kind of wrap our head and help the organization think about what level of risk do we need to take in order to produce the returns that we need to get to. So that's the first transformation that I think is very important. The second one is all the tools that we've been relying on for the past, again, 20 years, are probably not as relevant as they used to be. Most of our models are based on data that go back 15, maybe 20 years if you're lucky. They all have embedded volatility, embedded correlations that reflect the past. And for a very long time, reflecting the recent past was probably good enough, right? Today, or even if you go back just 2-3 years from now, probably not so much so. Correlation between equity and bonds was really what we expected in the past few years. Same thing with what's driving the USD CAD currency. So how do we as risk managers adapt our toolkit in order to be more relevant or to continue to be relevant with management is to start using a bit more of scenario analysis. Obviously, I'm not inventing anything new here. And scenario analysis, stress testing has been part of our toolkit for basically ever. I just think it's taking a lot more importance now because nobody really knows exactly what the future will look like, but it's our job to make sure that management understands how the organization or how the portfolio will react to different set of scenarios so that they can take on risk knowingly from a strategic point of view.
Very good. Anybody else want to take a stab at this one?
I'll have a go.
Please.
So, you know, and I read your very good article, and I agree wholeheartedly with everything you said in it. The other thing I would add to this topic is, you know, risk. In my background, I used to work for a very regulated organization, an insurance company. I now have the opportunity to be in a different industry and able to sort of create the risk function that we want to create. And it is so interesting, as you say, bringing that strategic mindset. You bring more senior people with much more of a business mindset to the table. I don't want an army of number checkers and clipboards, etc. We need more people sitting at the leadership tables who are actually engaging in business decisions. It's a huge difference in the organization. The other thing I'd say is it's a bit like our jobs are to bring the structures and the data and the facts to decisions that lead business decisions to the right business decisions. It's not my job to actually make the decision, but it is my job to make sure that I have equipped our leaders with the right facts.
I'm glad you mentioned that. So I think most people would assume that the CRO's role and the teams that you manage is to look at the negatives and then to avoid losses instead of looking at risk as an opportunity, as a business opportunity. And I think that's what you were touching on. I do have a question. It says, how do you contribute to business and strategy without being the naysayers? And I think this sort of ties into, again, it's not just about looking at the negatives and then trying to avoid losses, but to build the function into becoming partners to develop for business development. Is that accurate?
It's bang on. And there's an obvious one which we've touched on multiple times already this morning. But look at AI. If I were sort of, let's call it a traditional CRO, I'd be like, ooh, we're not touching that. Okay, well, then a year from now, 2 years from now, I don't know what the time frame is, but we'll have a problem. We will be too far behind. So we've got to balance that offensive and defensive aspect increasingly in our worlds.
Yeah, I think the other thing is also identifying sometimes the risk of not doing something. Or not moving fast enough. So it's also looking at, you know, again, back to, are we making better decisions and do we have the right information to inform those decisions? And sometimes there's risk in not moving, and I think our job is also to call that out.
I think it's not about avoiding risk, but taking the right type of risk. And if I could add something, I've worked in the commercial world, but also in the public sector. And my experience is that when you work for a government organization, there's a high degree of risk aversion. But actually, when you're actually executing or implementing programs for the public good, you actually need to take risk. That there is sometimes a cultural mindset in the public sector that makes you avoid risk. But it's not about taking risks for increasing profitability. It's actually taking risks for the public good. And that's actually a very difficult calculus sometimes, but absolutely essential if you have government that works really well.
Very good. So now that we've established that aspect of the job, maybe we can switch a little bit and talk about international comparison of how we view risk maybe in Canada and then beyond Canada. Romy, I'd like to turn to you on this one. Having spent your career in Canadian financial institutions, BMO, CMHC, and now with the IMF, in your view, how does Canada's risk management culture and regulatory approach compare to other major jurisdictions? What can Canadian professionals learn from international best practices? And conversely, what are the strengths that we can leverage ourselves?
Okay, so first of all, I want to say I'm so happy to be in Canada. I've been in Washington, D.C. for about 18 months, and I just flew in yesterday, and it's so, I feel like I'm sort of back home, so it's really great. So I wanted to start with that. And just a little brief recap of my career. As was said in the introduction, I spent half of my career in Canada in commercial banking. Then I went to CMHC for another 10 years, and now I'm at the International Monetary Fund. And I'm so grateful for the experiences I had in Canada, for the successes I've had in my professional career. And the risk management practices in Canada are really robust and I think are really of the envy of the world. And I think Canadians are a little bit modest by nature, so sometimes we don't take that for granted. So I just wanted to start with that. And I think I've highlighted some of the things. Our banks are so strong, our financial institutions are strong, our regulatory system is world class, and I think there's a lot that we can take pride of. I remember I was at, I think, a U of T listening to, I think, the current bank governor talking about the response, Canadian response during the GFC. And he talked about the great dialogue that existed between the public officials and the industry, and some of the quick actions that we took to stabilize the Canadian financial system. And we sort of take that for granted, but that doesn't happen in every country. And I think we need to just reflect on that and continue to invest in public institutions and continue to increase the dialogue between industry and the public sector. Being at the IMF, I have a little bit more of a global perspective right now, and I think one of the interesting things that we should reflect on is risk-taking as a country. I know there's big debates about productivity and how I think it's an opportunity now to think about what's next for Canada in terms of an economic development perspective. And I think it is, are we taking the right risk as a country? Do the regulatory rules make sense? Are there things that need to be recalibrated? Because I do think in this uncertain world, the risk profile is quite uncertain. And I think we need to build on the amazing institutional strength we have as a country in our banks, in our financial institutions, but also in government to do the best for our country. And I think, I always think never waste a crisis or never waste a period of uncertainty. And I think there's ways to use risk management tools to grow our economy, to make sure that we're really set up for success in the 21st century.
So let me ask a quick follow-up on that one. There's an opinion piece in the Financial Post not too long ago suggesting that the lack of appetite for risk is holding the Canadian economy back. And I think you touched on it when you said the debate around the productivity being sort of lagging the US, and there's always that refrain that go back to, well, we're not risk takers, or our CEOs and business leaders aren't risk takers. Is that kind of a intellectually weak argument that you should point to risk and say, no, we're lagging because we're not taking enough risk, or is there some credence to this argument?
I mean, I think the issue is a lot more complex than that, but it's one aspect that can be looked at for sure. I absolutely agree with that, and I think there's opportunities. I saw a recent article about OSFI, revisiting the RWA rules, risk-weighted asset rules, and thinking about, are the regulatory rules around capital really aligned to the risks that exist in the business? Like, that's a really good step that can be taken. But that alone, I think in the article, is not going to solve our productivity challenges. But I think it's incumbent on all of us to think about risk and taking the right types of risk. And I don't think it's very helpful to point the finger at, industry CEOs or the regulators. I think it requires all of us to think about all aspects of the economy and make the right decisions, basically.
David, anybody, Kelly, want to add to this discussion?
Okay.
Moving on. Very well. So we touched on this a little when we discussed the overall risks that have you concerned, and maybe we can sort of get into a bit more detail and sort of touch on a worst-case scenario if it ever sort of materializes. Shannon, you have oversight of Scotia's credit portfolios, and you're managing through significant economic uncertainty. At home, Canada's mortgage renewal cycle is about to hit with a fair bit of anxiety. I think we're all feeling that. And there's just a sense of uncertainty and volatility for the entire economy. How are you adjusting your credit risk models and early warning systems? Are there specific indicators that you're monitoring most closely as potential leading signals for credit stress?
Yeah, so I think a lot of what we're monitoring is probably what you would expect to be monitoring on a large credit portfolio. I think where we're probably more focused is, getting more granular insights and data into what's sitting within the portfolio. So if you think about, geographies, if you think about demographics, if we think about, higher risk populations, if we think about cohorts that maybe, came through when the housing market was, really, booming and valuations are coming off. So we're really kind of focused on understanding kind of what is sitting within the portfolio and what is it that we can do with our clients when and if they need our support. Certainly the renewal cycle is something that we're also monitoring quite closely. If you look across the industry, 2026, there's an awful lot of renewals coming through the system. And while I know we had another rate cut this morning, the rates are coming down, they are not where they were a few years ago. And so while that payment increase is not as maybe severe as it was, there still is more stress in the system. And then I think Romy mentioned it earlier, if you think just broader affordability and uncertainty and everything else that's going on within the marketplace, we have to really take that into consideration when we're managing this portfolio. And then the last thing I would say is back to preparedness and scenario planning is, are we ready? Do we have that downturn playbook? Do we know how we're going to manage, when and if perhaps the environment's even more challenged than it is today?
And if I could add something to that, I agree with the comments that Shannon made, and also I think David made the comments about the importance of stress testing the scenario analysis and using your creativity to think outside the box. And one of the things, I was talking to the IMF FSAP team, and we do our own stress tests as well in the Canadian, say the mortgage portfolio. But the historical data is very benign, in terms of there hasn't been a lot of losses in Canada. But you can't let that guide your future projection. And so the data sometimes is not there to support the stress testing. So you need to really think outside the box. And I think that's the role as a risk manager. I think it's one of the few OSFI guidelines in the stress testing that says you have to use your creativity and in really thinking about things that could happen. Because as I mentioned earlier, the next crisis is not going to happen in the way you think it does. So are we really using all our intellectual powers to think about those possibilities?
You did mention in the opening IMF's Financial System Stability Assessment for Canada, and if I could just summarize it, it was a very positive report in the sense that the report found financial system is resilient, well-capitalized, and governed by an effective regulatory system. But it also indicated that risks remain, specifically with a weakening labor market and the broader economy. There wasn't an explicit acknowledgement that Canadian financial institutions are exposed to commercial real estate and housing. Do you see a danger for a worst-case scenario that if there is a protracted time period for labor market weakness, if this lasts? I mean, there's a lot of uncertainty right now in the world. Businesses are holding off on investment decisions, on hiring. So this could potentially lead to a rather long-term period of economic slowdown.
Yeah.
Given the exposure, even though, again, acknowledging the positives, given the exposure that Canadian banks face to real estate, commercial real estate and housing, could we be in for a worst-case scenario? And I'll quickly also add, latest from StatsCan, household debt service ratio is ticking up. Household credit market debt to disposable income is up. The unemployment figures for August, 66,000 jobs lost in August. Granted, most of them were part-time, but still not a good indication. And recently, Equifax, 1.4 million consumers missed credit payment in Q2, for example. So these things are beginning to emerge. Are we at the early stages of potentially a bad scenario for the Canadian economy?
So as part of the FSAP, the IMFT does stress tests, and the Canadian banks do fare quite well through the stress tests. The capital positions are very strong, and this is not by accident. Post-GFC, there were regulatory reforms, and the capital positions of the banks have really strengthened, and liquidity positions as well. Mm-hmm. So, I mean, all the details in the report, but I think, I think the system is in really good shape. But I think the point is, this doesn't mean that we can be complacent, and I think I don't have a crystal ball, and as you mentioned, unemployment is the biggest driver of losses in the mortgage portfolio. But how the uncertainties, the trade uncertainties, how they're going to unfold, this is sort of the million-dollar question. But I think it requires continual vigilance and thinking outside the box and really preparing for that worst-case scenarios, but at the same time being positive and thinking about how you can grow the economy and do well for Canadians.
I think it's an issue because you can have it, you can look at it from a Canadian angle, but I think that's the question we're all kind of wondering, right? And that goes back to your point about the markets. What's going to break it? You know, it seems like our neighbors have been trying a lot of things that we would normally expect to have a significant impact on the market. Yet, if you go back to April and you look at, you know, where the S&P is today, you'll be surprised to know that's a new historical level, right? So that's the part that's probably making our job a little bit more difficult, right? Because you keep on coming up with those stress testing, and then a month later, reality tells you that whatever you thought would happen with tariffs did not translate into whatever assumptions that you have. So it does make our risk job a little harder. But there has to be something at one point that might break that trend, and that's the thing that really worries me, is we don't have a clear view right now of what that might be. So it's true for the Canadian economy and housing, but I think it's very true for, just globally speaking, the markets as well.
That's a good point on the stress testing. And another question I have is that given that the scenarios, the stress tests are based on past events, how do you incorporate the new emerging, especially now in today's world with, again, the new technology, the emerging technologies, just broad volatility in the economy, changes in policy that could quickly, you know, one day there's going to be 50% tariffs and the next day, oh, it's down to 25 and then back up to 75 again. So how do you keep up with your stress test, the modeling? How do you work that in?
I think it goes back to what Romy mentioned before. You have to be creative, right? There were 2 years ago, there was no scenario where you would have the type of tariffs that we have right now in the economy. So you can't go back to history, or you have to go way, way, way back in history to be able to build a scenario like this. So you have to invent something. And the truth is, you'll probably be wrong, right? And we did, maybe a year before Trump was elected, we had that whole thing where we built a scenario and we had a discussion with the executive committee. And they were challenging, you know, doesn't make sense, S&P's not gonna go, you know, everybody has their own opinion about how whatever events is gonna translate into markets or the economy. The point is, at least we tried. We had an educated discussion about it as an executive committee. We understood which part of the portfolio would be more vulnerable to a tariff hike. So when it happened, I think everybody was a little more calmer and ready to tackle on what was coming. In the end, we weren't that far away from what actually happened, which is never a good thing when the risk guy was right with the scenario. But still, I think it just helped the organization prepare for what was coming. So the truth is not to be 100% right. It's really make sure that we are prepared for those scenarios.
That is such an excellent point, because sometimes, I think sometimes senior executives can get a bit confused and they sort of think, well, hold on a minute, you're supposed to be predicting the future and we need to sort of understand what is going to happen. All right. Absolutely not the job. The job is to withstand the future, not to predict it. So couldn't agree more, David. It's really about, you know, hey, how can we be more prepared? We recognize a whole bunch of things can happen, but how can we actually get our heads around a multitude of different things that can happen? And it's almost about the creativity of the scenario rather than the comfort of what we already know.
Yeah, and the last thing I'll add is also the frequency. I think one of the things, as you think about this environment, maybe the cycle or the cadence by which you used to do those exercises, that pace is much faster now. So, you know, back to having the capabilities to be able to do that, I think, in a more timely basis is really important as well.
Very good. So, something that isn't getting a lot of attention lately, again, with everything that's going on, especially also with the shifting policies in the United States, and that has to do with climate risk. It almost seems like it's just moving down the ladder of key priorities. Kelly, you're responsible for both risk management and corporate sustainability at IGM. How do you integrate ESG risk consideration into traditional risk frameworks? And now we're also hearing reports that companies aren't reporting on ESG anymore, or there's been some backlash against greenwashing. I think as of yesterday, the OSC is taking first ever enforcement action for degree of greenwashing. So how do you work that into your assessments?
So I'll answer that in a couple of different ways. First of all, obviously, as the CRO, I have responsibility for corporate sustainability. Makes tons of sense. But in all seriousness, there are two ways that I'll answer this question. One is, look, I mean, you'd have to be living under a rock to not realize that this is fraught with risk, this whole topic. Walking a tightrope of sort of, on the one hand, are we getting over our skis? On the one hand, are we not doing enough? We've got different stakeholder groups wanting different things. Make no mistake, this is no easy task navigating this. The boring and technical answer to your question is we treat it in exactly the same way as we do all other risks. In other words, we govern it at a senior level with an executive steering committee. We identify the risks associated with it. Wait for it, the IMMR is coming out. We measure it, we manage it, we monitor it, and we report on it. It's all very basic stuff, and we have real measures that we follow and that we all stack hands and we say this is where we're aiming as an organization. So that's the sort of underpinnings of how we do it. But it is not lost on any of us that this is one of those ones, and Shannon was referring to it earlier, we are increasingly having to be nimble as CROs and to stay on top of things that are moving at pace. And this is very much one of those topics. It is not an easy task at the moment.
So when you see these reports, is there some degree of sympathy that the job is just really difficult to report? Especially, there doesn't seem to be standardization across institutions.
You're absolutely right.
Do you feel sympathy then? Is that something that...
Well, you are absolutely right. There is no real sort of gold standard of this is how you can sort of measure whether you're doing a good, bad, or indifferent job. There are lots of different bodies that will articulate, this is why you should be good on our bit, and this is... But there isn't... The whole space hasn't consolidated enough yet for us all to be able to say with clarity, right, that's the playbook. And it's a bit like AI, right? I mean, we were all talking about credit risk earlier, and because I don't have a balance sheet business largely, it's not a space that I have as high up on my list of worries. But largely speaking, the playbook for managing credit risk is largely laid out. There are going to be some curves thrown at us, but the financial risks are pretty, I don't know. We kind of know how to deal with them. It won't feel fun when we go through all of this shenanigans. But it's the stuff where, you look at AI, and listen, if anybody's figured out how to do the risk management for AI, please come and find me at lunch. I'll be very interested to hear what your thoughts are. But it's really challenging tackling some of these very, very changing areas. And that's the stuff I worry about.
Maybe if I can add, because I think it's important that we still talk about this. I understand it's a little less of a popular subject right now, and I think it makes it even more important for the risk management teams to really make sure that this remains at top of the agenda. It's not because it's unpopular that facts are no longer facts, right? We still need to address this face on. If I think about the portfolio in the long run, this will be one of the major drivers of the performance, right? Whether it's popular to say it or not. So the question is, how do we approach it now? And I think for us at Caisse, we decided instead of kind of shying away from this subject to really kind of double down on it. So we, I think, been at the forefront of trying to lead the whole discussion of how do we integrate ESG and climate into how we invest. So we've been integrating ESG criteria into our investment process for over 20 years now. In 2017, we came up with those carbon budgets to make sure that we reduce the carbon footprint of our portfolio, which by large, we are more than on track to achieve. We're about close to 50% of the carbon footprint of our portfolio down versus 2017. A lot of people ask us, how do we do it? We do it because we're committed. And two, the second part that they always tell you is that we linked it to comp, right? So if you really believe in something, you put it in comp, trust me, it will translate into results. The second thing is we had a lot of questions over the past year or so. So, well, now that we're at 50% less for our portfolio, what else do we do? Do we just continue that road? It's becoming a little difficult to get to the next 50%, right? So we decided to be a bit even more ambitious about it. So instead of just trying to think about our portfolio, is to really think about the real economy more generally. So not just think about how can we decarbonize our own investments, but how can we help decarbonize the overall economy. So instead of focusing on certain sectors, certain companies that are already at the end of that road, we decided to look at companies that had a clear path to decarbonization. So we are looking at sectors that we probably wouldn't have looked at a few years ago, but because we believe that companies that do have that clear path to decarbonization will be winners in the new economy, we feel it's important for investors like us to support those. So it's still very much a subject of importance, and like I said, even if others don't talk about it as much, I think it makes it even more important for the risk teams to make sure that this remains a critical risk to discuss with executive committee and the board.
Do you have any specific concerns then for, I mean, green investing appeals to a unique segment of investors. Again, with the backlash with greenwashing and the reporting not being standardized, do you foresee a situation where investors might say, you know what, this is no different than any other form of investment, and it's being labeled as green investment when in fact it really isn't? Is that a concern?
I think the question I get the most is not whether it's greenwashing or not, and I think that might be less of an issue today. People don't really tend to wear green all the time in today's world. I think it's more of a question is, can you talk on one side about decarbonization and all that great ESG and climate stuff, and the other side about returns, right? Because people love all that stuff, but at the end of the day, if it translates into less returns for our depositors, then we're just not doing our job. So I think the part that we're really focused on is to make sure that every time we make a decision, we do consider climate and ESG and all of that, but it's never to the detriment of the returns that we want. And I think that's the part where, you know, the jury's still out a bit. You know, there's a lot of partners that come to us with those ESG green solutions. Not always easy to see how that translates into the right level of returns. And I think that's where the sector as a whole needs to make sure that we can put two and two together.
So shifting our attention to something.
Risk. And the last thing I would say is that collaboration is so important in this space. And so talking to peers, talking to other industries, talking to regulators, seeing what's happening globally around the world in this space is really critical to pull that into our approach.
So when you talk about sort of a global approach, I mean, even something as basic as data privacy laws are different in the States, in Canada, even within states themselves. Like different states have different privacy laws. So in an environment like this, when you have so many different regulations and the enforcement of those regulations by smaller jurisdictions, not just on a national basis, it would make the job really difficult when you're relying on a global team that perhaps assumes that the regulations are standard.
Yeah, but we don't assume that regulations are standard. I think that's key, right? So we have a global team, we have teams in local markets. We need to obviously operate within the regulatory environments where we have our footprint. But this is, again, where I think you benefit from being in different footprints. You benefit from seeing what some of the best practices are in different industries. And then again, there are always constraints in terms of what you can and can't do in certain markets, but that is just something, I mean, that is our job, to identify how to factor that into our coverage.
And we really haven't heard of a massive crippling attack. So I'm assuming like you're doing something right, because we haven't heard of these massive crippling attacks. What can you tell us about the level of sophistication that the bad actors, I mean, you know, banks have great technology, but I would assume the bad actors are also using advanced technology as well. Have you noticed, do you see a change in the kind of attacks, the level of sophistication of the attacks?
Oh, I mean, absolutely. And I'm seeing a lot of nodding on the panel as well. And no great surprise. I mean, we've been alluding to some of the capabilities from the bad actors. And you don't have to be sort of the wearing a hoodie, sort of, you know, has been obsessed with, you know, coding all your life to be a bad actor these days. It's pretty easy, actually. I'm not going to tell you how to do it because I don't think that'd be helpful. But it's not hard anymore to actually sort of come up with ways to get into organizations. And the worst possible thing to be is at the back of the pack. If you're at the back of the pack, you're in big trouble. So what we all try and do is make sure that we're not the limping gazelle at the back. You've got to make sure that you're right up in the pack and help each other. And the other thing I would say is, look, CROs worry a lot about cyber risk for bloody obvious reasons. But also because the board is very triggered by cyber risk. So, you know, it's because it's often idiosyncratic risk, it's very particular to an organization, quite often, not always, but quite often. And the board gets very, very concerned about that, rightly, because they can envision themselves in orange jumpsuits, sort of in a very unfortunate situation. And so that's terrifying. And the reputational risk associated with some of that idiosyncratic attack is a real problem. But I think it's incumbent on us as CROs to not just talk about how we withstand attacks, and that is key, but it's also incredibly important to talk about how we actually deal with an attack should it happen. Because an awful lot of the damage that can be caused is actually in messing up the response. It's all a bit hackneyed now, isn't it? It's not an if, it's a when sort of thing. Everybody's been saying that for years. Hackneyed because it's true. So, there's an awful lot of opportunity for us collectively to really, really engage our muscles around how to tackle the situation should it occur.
Maybe I can add that the prevention is also something to really spend a lot of time on, because we're always one careless click away from somebody in our firm from having something to manage that's going to be very complicated, right? So how do you make sure that the people that are probably the door by which the event's going to occur understand enough the risk that they're taking for the organization, and they can build the right judgment calls? So we spend a lot of time on the training to make sure that they understand. So those phishing tests that look very random and very basic are actually something that's pretty important. But then you have to give them some feedback. Say, hey, we did all those tests. You're not so good at it, buddy, right? And you have to be able to really train people to develop the right reflex, because most likely, if there is a cyber event at your firm, it's because one person out of the thousands that can work for your organizations made a wrong judgment call.
Well, that's an interesting point, because sometimes when we talk about cyber attacks, we just assume like a Hollywood movie style, somebody's sitting with like several different screens and they're cracking the code and they're accessing the vault. But something as basic as just a phishing attack, just opening up an email,
Exactly.
then that would be it. So,
If I could just add a few things. I think Shannon made the point that these bad actors, they don't respect national boundaries. And I think there's a lot of collaboration going on internationally and across different authorities, and I think that's something that needs to continue and be strengthened. In terms of just my personal experience, working through a cyber incident, is that it's great to do all the stress tests and practice ahead of time, that things never happen as you predict. But when things are happening, it's really important to have experts that you can draw on who've gone through it before. And it's because you have to make decisions very quickly, and having that expertise at your fingertips is very, very, very valuable. So that would
on international collaboration,
Yes.
do you find that happening as much as you'd like it to? And also, there are certain countries that have alliances, I guess, for lack of a better term, that, yes, information sharing happens and collaboration on fighting crime happens, but technology is sort of advanced to the point where some of these attacks might come from jurisdictions that don't have any sort of relation with, let's say, Canada or the United States or European countries. What if those attacks originate in those jurisdictions? There is no international collaboration.
But I think you have to take the higher road, and I think more collaboration is good. So to the extent that you can use existing international organizations to build those bridges, I think that's the best that you can do for securing our financial systems, for sure.
I will ask a question about stress testing. And we've mentioned this several times now, stress testing and scenario building and so on. So is stress testing the tried and true strategy to manage risk? What other strategies are you using beyond stress testing? Open to anybody.
So, you can have all the tools that you want. If you don't have the right culture, it probably won't matter, right? And I think we as risk management really try to think about how can we drive that culture going forward. How can we embed ourselves in the decision process, not to be in parallel. Our job is not to be a checklist. Our job is to make sure that we take risks that are aligned with the risk appetite of the board and of management. So if we're able to kind of translate that into something that's very concrete for our counterparties within the organization, then it's going to go back to what you said in the beginning. We'll be seen as true partners. All the rest all the tools, I mean, we have all different stress testing, VAR, and all that stuff, probably won't matter if you're not able to get across the message that risk is part of the business. Risk is there to help you make better decisions. We're not the enemy. And our job is to make you think about what's the range of outcomes so that ideally, whatever happens, you are as prepared for it as possible. So I think that the area that we should probably focus on and try to make sure that we are in the right spot for organization has a lot to do with the culture piece.
I couldn't agree more. You know, I know people always say this. I think it's almost like a cliche, but good risk management is what happens when no one's looking, and I totally agree with that. And I remember, just as a young, analyst working at the Bank of Montreal, seeing a junior employee raise a risk issue that probably had not the great business outcomes, but a senior, executive taking that person's views into account and making a decision, that kind of has a big impact on the whole work team, and I think it's really indicative of the culture of the organization, and that is very hard to build. And I think it's all incumbent on us as leaders to create that kind of environment where people feel empowered to speak out.
I love that point.
Yeah.
Sorry, I've got to dive in on that because you just described a scenario where somebody had the courage to speak up, but somebody had the courage to listen to it and show that they were listening to it. And it's actually really hard sometimes for the senior leaders in the room to actually listen to people and go, oh, okay, maybe I hadn't actually thought of something. And that courage thing that underpins the culture is really, really key. I totally agree with you.
And I think to make sure that behavior is rewarded. Because again, when you think about the reaction to that is so critical, and so it's also how do you really reward and reinforce that is the behavior that we want to see every day. Yeah.
I'm going to go back to a question on cybersecurity again. I think this is an important question. The current concern on cyber is an attack through a third party. So how does your organization ensure that your third parties are not engaged in backdoor attacks on the organization?
I can start. I mean, again, if you think about third-party risk, it's no different than your own risk. We still own it as an organization, so it is back to the programs, the processes you have in place to know who your third parties are, the expectations that you hold of them to be a third party. That's typically built very much into the contracts in terms of what visibility you have to be able to see through, and the notification requirements coming back to us as an organization. So I think the point there is just to really reinforce that risk is our risk. We're not offloading that risk. We own it.
Yeah, and it is a bit grimly boring, but Shannon's right. It is the basic programs and making sure you're doing them. Brilliant basics. It's you've got to know who your third parties are. You've got to know if there are any fourth parties out there. Wait for it, fifth, sixth, and making sure that you actually understand the contract, that somebody's actually asked for the SOC 2 and checked the SOC 2, and it's grim stuff. But it's really important stuff. And you know what it's like. The CEO is going, I need to onboard this mad fintech thing over here. And you're like, okay. There's always going to be a challenge, but you've got to sort of keep up grimly with the program and keep at it. Because Shannon's absolutely right. Our perimeter extends into our third parties.
So we are approaching time. And before we conclude, I'd like to ask, given everything that we know about the uncertainties in the world now, do you have an optimistic view of where we're heading in terms of the broader risks, or maybe neutral, or maybe a bit of a pessimistic view? There's so much going on in the world that, again, the geopolitics and wars notwithstanding, I think there's just even something as that occurs on a daily basis, like cyber attacks and hacking.
Yeah, I can start. I mean, optimistic. I think it's a challenging environment. I'm optimistic that we as risk management professionals are positioning ourselves well to manage it. I think I'm optimistic that we're all getting more nimble, agile. There's better capabilities that we can, leverage to manage it. But I think it is a challenging environment. And I mentioned it earlier, it's changing every day. And I think we have to be really prepared to operate in that type of environment and be prepared.
I think risk management, by nature, you're always sort of thinking about the worst case scenario. But I think when I actually talk to CROs, they're actually glasses half full people too. And I think they want to add value to the business and use risk management tools to make the best decisions possible. So it's not a blocker of decision making, but an enabler of good decisions. And I think that's how I like to spin the optimism of it, because I think we're so fortunate to live in this great country, and there's just so many opportunities in the world. And I fundamentally believe that there's good to come. And I think we need to use all the tools and intellectual capabilities that we have to make a difference in the world. And I think that's what's really important.
Two answers. I am an optimist.
Yeah.
And I could say, yeah, I agree with the two people that went ahead of me. But you asked a very specific question. Am I optimistic or not? Right now, at this moment in time, no. I think we are entering a huge period of uncertainty. I hark back to the conversation that Gary was talking about earlier. Putin's on the march. Geopolitically, we're wholly unprepared to deal with the world as we stand today. And if somebody tells me at lunch that they understand or have a really good prediction about where AI is going, I'm going to say, I don't believe you. And I think this is a really frightening environment that we're living in. The best we can do as risk professionals is keep on top of it to the best of our ability. But we ain't seen nothing like this.
I think I'm more realistic than optimistic.
That's another word for pessimist.
I think I mentioned in the beginning, there's going to be winners and losers in every sector, right? So that will create opportunity. Some organizations will be able to do things that we can't even imagine today, and some of them will disappear. I think the big changes, those things are happening much more quickly than we've ever been used to. So I think I'm optimistic that some will be able to leverage everything that's happening, but we have to be realistic. We're not all going to be winners.
Thank you. I feel like the pendulum is sort of tilting towards optimism, but maybe it could be pulled back a little bit. But ladies and gentlemen, thank you so much. This is all the time that we have for today's session. I feel like we could have kept going. Thank you to our panel for sharing your thoughts and insights. And I will now hand it back to Vanda.